Conventional loans. So essentially we're going to be teaching you about three types of loans. And the conventional loan has two versions of what we call a conventional loan. We have conventional loan, conventional financing. We have insured conventional. And we've got FHA and we've got VA. So first of all, conventional loans. What conventional loan means is there's no government involvement. There's no FHA insurance. There's no VA guarantee. You just go to the lender and you qualify for a loan. That's called a conventional loan. So the debt payment is based solely upon the borrower's ability to repay. The loans are not insured by a private sector. It's not an insured conventional. Not insured by the public sector. It's not FHA, or it's not guaranteed. VA guarantees loans. Now, to get a conventional mortgage, the maximum LTV, loan-to-value ratio, is 80%. So I should say this to you. The lower the LTV, the lower the amount borrowed, typically the better terms you can get. There's less risk for the lender. So if a person has cash and they're okay with putting that cash into their home, bad thing at all, usually it's a conventional mortgage that's going to give you the best terms. They're the least risky type of loan for a lender. And the higher the down payment, the lower the risk for the lender, and that might translate into better terms for the borrower. Now, if the loan exceeds, if the LTV exceeds 80%, then there's this thing called private mortgage insurance, PMI. Private mortgage insurance, PMI, protects lenders from loss due to a deficiency after foreclosure. Now, lenders are going to require insurance on any loan that's got a LTV above 80%. So if you got an 85 or a 90 or 95% LTV, then your borrower is going to be paying PITI. You see what I mean? Principal, interest, taxes and insurance, and private mortgage insurance. Now, when you talk about mortgage insurance, there's a thing called FHA that came into being after the Great Depression. And within a few years of seeing FHA, which was a mortgage insurance program, government mortgage insurance program, the lenders said, you know what, that's a good thing. Let's do our own. And they formed this thing called the Mortgage Guarantee Insurance Corporation. And the Mortgage Guarantee Insurance Corporation, the borrowers pay premiums. The borrower buys basically an insurance policy on behalf of the lender, or the borrower pays for an insurance company on behalf of the lender. And notice, this PMI only kicks in over 80%. So the insurance covers any losses the lender might incur from doing any LTV above 80%. Not the entire loan. PMI does not insure the entire loan balance. Got a picture coming up of what I'm talking about here. So this is something you want to highlight. PMI does not pay off the full loan. It's not a get out of jail free card by any means. What PMI does is it covers a portion of the shortfall between the amount obtained through the REO sale and the outstanding mortgage debt. Sometimes I'll teach it this way. You've got insurance, you got dental insurance. You go to the dentist, you need a crown. Crown's going to cost $1,200. Your insurance company says we give you $6. Boom. They don't insure the full amount. They say, here's what we'll pay for, we'll indemnify you this much for that loss. So it pays a portion of the shortfall. So I put this together. See if this helps at all. Just in your understanding, the thing I need you to know is that anytime an LTV, a loan goes over an 80% LTV, it's insured conventional. And that means private mortgage insurance. A conventional loan, max LTV is up to 80%. Over 80%, that means over 80% LTV means it's got to be insured conventional. That's what you need to know. You also need to know that the PMI, the private mortgage insurance, does not pay off the entire loan. That's it. So the rest of this I'm really working on is understanding here. So the borrower defaults, the lender forecloses, then sells. The private mortgage insurance will partially indemnify lenders for losses over the 80% LTV. So let's say we've got this situation here. The borrower put down 5% down. They got a 95% LTV, $100,000 loan. All right. Borrower defaults, lender forecloses. Lender, the market has crashed. Lender can only sell the property for $50,000 at a foreclosure sale. They've lost $50,000 on their loan. All right? They're not going to get $50,000 from the private mortgage insurance company. First of all, PMI doesn't cover anything under an 80% LTV. So the private mortgage insurance might pay back a portion of this portion of the loss. So let's say $50,000 lost, we'll pay 15% of that. Something like that. So it's a partial indemnification. It indemnifies them only for the risk the lender's taking above 80% LTV. The advantage for the borrower, of course, is a lower down payment. The disadvantage for the borrower is a higher payment. The lower down, the more loan. The more loan, the higher the payment on the loan, plus private mortgage insurance. Here's an example of what we're talking about. We've got our little graph here again. Remember, you put 20% down. 20% down means an 80% LTV. So if that's the case, you're putting this entire amount down right here. That's 20%. 80% LTV. Advantage, best terms, and no private mortgage insurance premium to pay every month. But if you only put down 5%, that means your LTV is going up to 95%. That requires mortgage insurance. Here's the portion of that debt that the private mortgage insurance would cover. Advantage to you, lower down payment. That's your main motivation. Your monthly payments are going to be higher. You're going to exchange that for the lower down payment.